welcome to a brand new edition of Ideas for Profit on Moneycontrol. I'm Neha Bothra. Today we are going to focus on State Bank of India as an investment bet. State Bank of India is the country's largest lender, a Fortune 500 company, and the company beat street estimates in its third quarter earnings results reported yesterday. In fact, even though profit declined 7% on a year-on-year basis to a little over 5,100 crore rupees, the bank did win the thumbs up from analysts on back of healthy loan growth, stable margins, and an improvement in asset quality. As far as asset quality is concerned, do remember you need to take the numbers with a pinch of salt because Supreme Court has mandated a standstill as far as asset quality recognition is concerned. Despite this, the bank has reported gross NPAs coming in at a little over 5.5%, net NPAs around 1.8%. Overall, the State Bank of India management also indicated that as far as requests for restructuring of assets is concerned, that was to the tune of 18,000 crore rupees. That is about 0.8% of the total loan book of State Bank of India. That is as far as asset quality is concerned. But I think more encouraging was the fact that the provision coverage ratio has gone up to 86%. That is an improvement of 460 basis points on a year-on-year basis. As far as other parameters apart from asset quality is concerned, credit cost stood below 2%, apart from slippages and GNPA that we told you have been on an upward trend, showing signs of improvement. Net interest income went up 4% on a year-on-year basis and 2% improvement on a quarter-on-quarter basis. As far as the loan book is concerned, overall advances grew 7% on a year-on-year basis, but this was largely on the back of the retail loan book that grew 15% on a year-on-year basis. As far as the retail loan book is concerned, do remember that 23% of the loans comprise of home loans, and that was the area that really saw some momentum. Overall, as far as domestic loans are concerned, we saw an improvement of 10% on a year-on-year basis. But what's the outlook for the company? State Bank of India, being one of the foremost public sector banks in the country, stands to benefit on back of the adequate capitalized buffer that it has on its books. Tier 1 capital ratio stands at 10.27%. Deposits saw robust growth coming in at 14%, and overall CASA and term deposits improved 15 and 13% respectively. In fact, remember that the CASA share in the overall loan book also improved marginally by over 45% in the third quarter. So these are some areas that do stand out as far as the overall outlook is concerned. And given the sheer size of State Bank of India's balance sheet that is pegged at 43 lakh crore rupees, coupled with adequate capitalization and the abundant liquidity we see in the banking system currently, helped State Bank of India actually command the lowest cost of funds in the banking space in the present situation. So, coupled with the fact that there has been a limited instance of restructured loans according to the bank management, legacy loans, the management has indicated time and again have been duly recognized and accounted for. These are some factors that augur well for investors who are keen to bet on State Bank of India on a long-term basis. But apart from this, one interesting area that stands out is the fact that State Bank of India has the ability to unlock capital by divesting stake in many of its subsidiary companies. But yes, we also need to point out one area that investors need to be cautious about. That is the fact that the government owns majority stake in State Bank of India, and as seen in the past, the bank could be called upon to bail out the weaker players in the sector, including NBFCs. We saw this happen in the first half of last year when State Bank of India was asked to infuse close to 6,000 crore rupees and take on majority ownership in troubled private sector lender, that is Yes Bank. So this is an area that investors need to be cautious about. But one area that analysts are very optimistic about is the fact that Budget 2021 proposals indicate an increase in outlay as far as overall capital expenditure is concerned. So remember that State Bank of India, being the biggest lender in the economy, will be among the first and biggest beneficiaries the moment we see the first signs of uptick in economic recovery, and as and when infrastructure activity actually picks up in the form of construction, etc. But what about valuation? the valuation plays a very important role, and analysts feel that at the current market price, with the stock trading a little over 0.8 times of the fiscal year 2022 estimated core book value, analysts believe that this is a good long-term option that investors can consider to add to their portfolio, mostly on back of the improvements seen in key operational areas of the bank. And then, of course, remember that State Bank of India, being the biggest in the banking space, will meaningfully benefit as and when the financial sector sees an upturn with the economic cycle improving as investments and consumption pick up in the coming months, as expected by most economists and analysts. So yes, while State Bank of India is among the most vulnerable to fluctuations in the economic cycle, it also stands to benefit as greatly. And asset quality concerns, though still present, are relatively less in degree, considering that the management has confidently reiterated that the provision coverage ratio of 86% has been increased, and a lot of these legacy accounts have been duly provided for. But more importantly, despite the recent rally we have seen in the State Bank of India counter, should investors really jump in and buy the stock? According to analysts, there is more juice left, and it could be a good long-term investment bet. But we must caveat it by saying that you need to consult your investment advisor, because all market investments are subject to risks, and you need to understand what your appetite for risk is. And with this, it's time to wrap up this edition of Ideas for Profit. Thank you for watching, and goodbye.